or stays here through the course of the day. Okay, coming off a little bit at 0.14, 0.15%, 23,430, 23,440 or so is where we're at. I mean, the market breadth is positive, over 2:1 in favor of advances to declines. And that's the heat map. It's a more normal kind of a day with lots of stuff up, lots of stuff down, at least on the Nifty. Tata Steel, BEL, Max Health, etc. are starting in the green. Infosys, HCL Tech, Wipro are starting in the red at this point in time. Markets now flatlining, just about 7 points left on the index. Rima.
Well, indeed, markets are attempting a comeback, but there is still caution in the air. Remember, Brent crude prices have crossed $103 per barrel in today's trading session, which compares with a little more than $100 per barrel that it was in yesterday's trade. The Nifty and the Sensex, after opening up higher, have now dipped into the red. Sensex down 35 points, Nifty lower by 15 points. Yesterday, we gained 250 points on the Nifty. This morning, unable to build on that upward momentum, at least in early trade. So let's start with the loser, since the index is flashing red. It's I think the biggest loser today are the IT names: Infosys, HCL Tech, Wipro. They're down nearly 1%. Asia's in the green, but the big gainers there are the ones related to AI, the NVIDIA beneficiaries like SK Hynix, TSMC. So India doesn't really have that play, and you can see the softness in IT names. Top three Nifty losers are the IT stocks. Then you've got Adani Ports under pressure, Eicher Motors on the back foot, HUL, Titan. Consumption names are weak. L&T is under pressure. That's down close to about 0.5%. On the way up, metals are doing well. You've got Tata Steel with a gain of about 0.75 of a percentage point. BEL, defense continues to see buying. Asian Paints in focus. Many of the paint companies had announced price hikes following the rise in crude prices, so that's supporting the strength in Asian Paints. ICICI Bank, in fact, banks too are in the red. Yesterday, banks made a comeback. There was buying visible in many of these large cap banks. But today, there is green when it comes only to an ICICI Bank. HDFC Bank currently is in the red, and that's dragging its feet with a cut of nearly 0.5%. Reliance Industries should come up for you on your screen because they made that big announcement, a $3 billion deal with Samsung C&T for a 15-year supply of green ammonia. Reliance Industries is on the flatter side. All in all, the Nifty is just a shade below 23,400, unable to add to yesterday's gains.
Well, this 23,500 has become an important resistance mark. Even today's gap up, the high of the day is around 23,493. Yesterday's high was around 23,500 or thereabouts. So a higher high is something that you're hoping for. But that's not happened in today's trading session. So that's something that we'll track. Even on the Nifty Bank, yesterday's high was at around 54,664. So you'll want that number to get breached. Individual stocks, that we're looking at. Kalpataru, that stock, in fact, is up close to around 8%. There was an auto bin out there, so that one is bucking the trend. Bajaj Electrical, fundamental positive news coming in there. That stock is well up close to around 5% as we speak. So good move is what we're seeing on that name. ITI, yesterday the stock moved on high volumes. Today as well, it's seeing some follow through. So good move on that particular name. Big move is what we're seeing out there, and some bit of a follow up. Jindal Saw as well up close to 100%. On the flip side, MRPL, that spiked up yesterday big time. That's coming for profit taking. In the final hour, you saw Ola Electric that spiked up. That as well has come in for profit taking. And Redington, just a month or so ago, the stock was close to 300 rupees. That's corrected to around 220 rupees. So a flattish start. The good news is number of stocks advancing, at least equaling the number of stocks declining just for now.
All right. I think we've got, things flattish now. By the way, silver Bs once again, right? I mean, I can spot a lot of these silver ETFs which are up 3%, 4%. International silver prices are back above $80. So that is something. I mean, silver has been a huge area of trading activity all through this year, all through this, this 2026. Well, I think just a few other names. GMDC is up 3%. It's the number 3 largest volume-led gainer. Amber is up about 2%. Bajal Products, I think it was coming up 2.5% on this one, 172. It's coming up with very large volumes. So, yeah, I mean, there is some stuff. GE Shipping is coming up with about a 3% pop. But, volumes are low. I mean, the volumes are there for about 10 stocks. I'm talking about NSE 500, and then volumes taper off completely, at least right now. Coforge is coming up with a 3.5% cut, 1,045 on Coforge. It's got volumes on it on the downside. So keep an eye on that. Hindustan Copper is down about 2%. So NTPC Green is down about 2%. Again, I mean, 10 stocks have got volumes on the downside and then things taper off completely. So 23,378 or so on the Nifty. Anand Shah is with us, CIO of PMS and AI at ICICI Prudential AMC. Anand, good to have you with us here. Thanks for joining us. For viewers who are watching, Anand, what's their advice really? Those who've been able to create some cash at higher levels, is this time to go back in, deploy in what way, shape or form? Like an ETF or large caps, a small cap fund? I mean, what would you recommend really?
Hey, hi, good morning, Prashant, and thanks for having me. So, yeah, I mean, we all along maintain that asset allocation is way to go, and one needs to be keeping an eye on asset allocation. As far as the situation that we are in today, I believe we don't have yet the end game here, and to that extent, it would be too premature to say that we have seen a bottom of a market, and to that extent, one should deploy all the cash that you have or all the cash that you might have raised to redeploy in the market. But I think we have some comfort that markets have become more reasonably priced through the last year. So it's not only this last 2 months, but otherwise also India has been one of a large underperformer through the calendar year last year. And to that extent, the relative valuations of India relative to the emerging markets in the world have become reasonable. And to that extent, I see it's a time to keep on adding a little bit on the equity at this point of time.
In what way will you do it? I mean, what's the instrument to do it?
No, I think, look, it's much more complicated than where we were a few years back, especially at least 18 months back. Very clearly, some things remain constant, which is India's demographics and the very stable macro.
Anand, what I mean is, should you go and buy in a systematic way? No one knows. No one rings the bell at the bottom or the top. With that realization in mind, how would you sort of slowly start to go back in? And because you can't perfectly time the bottom, it may be 1,000 points lower from here. It may be 500 points. Who knows, right? But you got to start to do sensible things. But what's the way to do it? Is it through exposure to through an ETF? Is it through a diversified equity fund? I mean, a single stock? That's my question.
I think now the products are time tested. ETFs give you passive exposure. Mutual funds give you active exposure. You get an advantage of having a fund manager doing stock picking to you in mutual funds. So either routes, or a combination of a passive and active. But what I was trying to say that the markets have become far more complicated to go directly into equity. And that's why I'm saying a professional use or a passive fund is a far better choice for an investor at this point of time than doing an actual bottom fishing on individual stocks.
Equity diversified or a small cap? I mean, an experienced small cap. You'd go with an experienced small cap fund manager. Given the damage we've seen, that's my next level question, Anand.
Indeed, I think the small caps again, like Indian equity markets, have underperformed significantly, and valuations is not that big a challenge as it was maybe in September 2024. But that again, one has to understand what is changing. While some things are constant, a lot of things have changed, and one of them is inflation. The outlook on inflation and this current energy crisis only complicates it. But even before we reach this current energy crisis, we had tariffs. I think, and in a way, we are moving more toward the globalized world to deglobalize more local manufacturing. So it has implications on inflation as it is. Interest rates were expected to inch up. Now there's additional burden of a higher energy prices across the value chain of gas, oil, coal, and everything. That complicates the matter further. It's only we need to see how long this stays and whether it has a permanent impact on the inflation outlook, because that has then implications on the stocks. Which stocks would do well, which stocks would underperform, and which would have been very different 18 months back.
So the mid-teens earnings growth expectation, Anand, for this year, is that at risk? And has your team told you which sectors, themes, where we could see cuts in earnings on account of the conflict, higher inflation? They may not be able to pass on the entire burden.
Indeed. So look, while India or at a NSE 500 level, we might have still a double-digit earnings growth rate, but the contributors to those earnings would actually shift. What are the higher commodity prices, higher inflation means that the asset-heavy businesses, the commodity producers versus commodity consumers. So commodity consumers can suffer, but the commodity producers, be it oil producing, coal producing, even metals manufacturer, those are the businesses which will actually might have a certain more than expected jump on the earnings, while to counter that, there would be the commodity consumers like autos and others might have some bit of lower profits or maybe a degrowth in profits because of this combination. So I think from the investments perspective, I think few things have changed. I think from our perspective, preference for value over growth, preference for profits today versus profits 5 years out, preference for more asset-heavy business or asset-light business is something which we have been continuously monitoring. And while we are doing stock picking and individual stocks matter more than sectors, but we are cognizant that a higher inflation means a segment of the market will outperform the other segment of the market, which would have been completely opposite 18 months back.
IT down now 25% from the start of the year, Anand. Do you think the potential derating is done or there is more to go? I'm not talking about numbers. Now, usually valuations get adjusted well before we see it in the actual numbers. But just purely in terms of the valuation right now, do you think there could be more pain?
Sorry, I missed the initial part. Is it the
IT, the Nifty.
IT. So yeah, again, immediate threat to the EPS is small compared to what the stock price has fallen. What actually people are still trying to figure out, and that includes us, that what would be its implications on the terminal growth rate, and that means what would be implications for a PE multiples for this sector. Do we see that the AI sustainably disrupts the total pricing power and it leads to a significant deflation to the pricing of the IT services? Then obviously things have changed. So again, we remain cautious on the sector and we continue to monitor it very closely. Again, I am repeating, they're high quality businesses, the cash generation is very strong, and the near-term risk to the earnings is much lower than what the stock price reflects.
Hi, Anand. Good to see you. And Anand, there is some kind of nervousness that's coming about from the mature retail audience because they haven't seen a big correction in the last few years. It's been pretty okay. Buy the dip and you make some money. So in terms of top-ups, in terms of putting incremental money to equities, someone had say 100 rupees or thereabouts. How much should they start dipping in post this recent correction? And given the fact that we're a couple of weeks into the war already.
No, again, look, if you have first and foremost, very important that
a long-term investor
in any environment as it is, you should have a long-term horizon, and more so importantly, while our outlook on the Indian economy and the markets might be again normalized, say end of June and July, we might not be discussing these risks because Strait of Hormuz would have somewhere settled and the flow of energy would have moved, maybe at a higher elevated price, but it will be still normalized. And to that extent, we'll go back to stock picking. So what we are telling our investors and our advisors that, look, it's a time, if you have a room to increase allocation to equity, you should do it over a 2-3 month period, because at some point of time, either the energy prices go up significantly and that leads to a demand destruction in energy, or alternative energy supplies took over, or basically there is some bit of thaw and there is a 20% of crude that moves through Strait of Hormuz starts moving, maybe albeit at a lower capacity, but it starts moving and things go back to normal.
Anand, that long-term thing, right, that you should buy for the long term, and you should, I guess. But you would completely, I'm assuming you would agree that the pace of disruption also feels like it's at all-time high, right? At least perceptions of disruption or actual disruption, we don't know. But it looks like everything is getting, we don't know the terminal. It's tough to kind of put a terminal value to anything at this point.
Interesting that you raised this point.
Yeah, let me, and I'll ask you to come in. But my point was, and tie this to the fact that what you said in the beginning, right? Because it's so volatile, better to give money to a professional fund manager, right? And they'll have to sort of go in, go out, and long term, short term. And so it's, but then it's also an environment where the skill level of the fund manager also matters a lot more, right? Compared to 10 years back. Not that it didn't matter, it always mattered. But I'm just saying that if the first part is true, the second part is also true in that sense, right? So makes a lot of difference who you give and where you invest now.
No, indeed, I think good you raised this point. But again, as much we all sort of discussing AI and its implications on various industries, it's good to remind ourselves that it's not the first time that there is some innovation, some new technologies coming through and which is disrupting certain businesses. It happened in the industrial revolution, it happened in the digital revolution. What it leads to, it obviously leads to a certain industries taking a much larger knock because they get disrupted. And invariably, these are the businesses which are high ROE, high profit making businesses, which in turn gets disrupted. But it also leads to an evolution or an emergence of new businesses. Just case in point, as the 4G sort of got fairly penetrated in this country, we had emergence of quick commerce businesses and so many new age businesses which are now recently getting listed. They would not have been possible. They would not have been there in the absence of that 4G technology. So every technology evolution will also lead to emergence of new businesses. At the same time, certain old age businesses which might get disrupted and might actually become a low growth or a no growth businesses as we go forward.
Yeah, no, that's absolutely true. But and eventually maybe it'll lead to abundance and everyone will be better off. But you got to get from point A to point B, right? And that's the problem. And that is 5 years, 10 years, who knows? And you got to be okay, all right, to come out all right on the other side. And
absolutely.
Yeah. Absolutely.
And as Nigel said, we haven't seen very sharp and long corrections in almost last 15 odd years. And to that extent, one should not forget, but we can actually have a low growth or a low earnings growth rate. Luckily for India, we have seen that between almost 2010 and 2020, we had abysmally low earnings growth rate while the economy was still doing okay. And we sort of survived that. The profitability was shade below 2% for almost 5 years between 2015 and 2020. So yeah, I mean, there's no doubt in my mind that a certain change in the environment can lead to a very low earnings growth rate. And that's why we, beginning of the year, stated that from here on it will be more stock picking. We'll need to stress test every company to the emerging macro risks and even macro opportunities for that matter, and see which of your companies are adapting to the changes, be it the new challenge being the higher energy prices to the AI challenges that we have.
Okay, all right, Anand, we'll leave it there. And thank you very much for joining us. It's a pleasure having you here on CNBC TV18. Well, I think what we're going to do is just look at the market, which is down 8 points. 23,400 is where we're at. Which means, let me just take a look at what we've done so far, right? I mean, I think, so we started, the market went about 23, almost 300. Then there was a very sharp sell-off and we got to about 22,980. A very sharp, sorry, beg your pardon, I'm looking at yesterday's session. Okay, we basically got a start higher, right? 23,500 was the high today, almost 23,500. And we've given that up, but we're off the lows as well. The low for the day has been made at about 23,360. So about 30 points off the day's low. So yeah, I mean, contained for now. Yesterday, of course, was much bigger, much wilder swings in that sense. Well, Tata Power is in focus. Vivek is here to tell us why. Vivek, take it away.
Well, that's right. This is a verdict that could have an impact, especially as far as consumers are concerned. You may now be able to choose, who will be your power supplier. Now, what's actually transpired is that there has been a verdict that has been declared at APTEL, which is the Appellate Tribunal for Electricity. That APTEL has gone ahead and dismissed BEST, which is Brihan Mumbai Electric Supply and Transport Undertakings appeal against a past Maharashtra Electricity Regulatory Commission verdict as far as parallel licensing is concerned. APTEL has gone ahead and ruled in favor of Tata Power for Tata Power to go ahead and do a phased parallel rollout as far as distribution network in the state of Maharashtra is concerned. Now, what is the background for this particular case? Remember, multiple companies had applied for parallel licenses for various areas across Maharashtra in FY23 as well as FY25, and post a 2-year period, the commission, which is MERC, had gone ahead and accepted as well as admitted applicants in June 25 that qualified for a grant of parallel licenses. Now, BST had gone ahead and appeal against the MERC decision, saying that they had undertaken significant capex and they do not want competition in areas where there was existing infrastructure on which they had done the capex. Now, JM Financial today has written on this particular development. They say that this particular move has implications on electricity amendment bill's proposal for carrier as well as content separation. They're saying that the likely passage of the bill during Parliament's monsoon session opens up huge opportunities as far as the distribution space in India is concerned. And they say that the likely beneficiaries include Tata Power, Adani Energy Solutions, CESC, as well as Torrent Power.
Thank you very much for that. Jonathan Garner, Chief Asia Emerging Equity Strategist at Morgan Stanley, is now joining in. Thank you very much for joining in. This is Rima here. Now, you downgraded India to an equal weight very recently. This happened in the early part of March. The question is, why now? India has already gone through 1.5 years of a time correction, price correction, and a very steep underperformance versus the rest of the emerging markets, Asian peers. So why now? Question number one. And two, with now an equal weight, what should we expect from India, say, in the next 12 to 18 months? No returns or very muted returns?
Yeah, so we made a number of changes to our recommendations about 10 days ago, and it's really all to do with the framework that we're in right now in relation to oil and gas supply. It is unfortunate for India because in January, the manufacturing and services PMIs moved up. And we obviously have had significant policy easing in India, and we had been cautiously optimistic about the business cycle turning and running a small overweight. But unfortunately, India is one of the countries in our coverage that has the most sensitivity to oil and gas imports within GDP. It's actually the third highest after Thailand and Korea. And so the prospects for the economy are dimming in this environment. It's also the case that India has relatively low reserves, strategic reserves of key commodities. They're significantly higher in the case of Japan and China. In terms of the second part of your question, we're emphasizing very wide bear to bull outcomes here. And in fact, this predates what's going on in the Gulf. We'd felt that geopolitical risk was high going into this year, and AI disruption was also high as a theme. And so I wouldn't want to put any firm estimates on likely returns for markets at this point. It's really a case of scenario analysis and very wide ranges on potential outcomes.
Jonathan, morning. Prashant here. So would you want to give us those, those ranges on both sides? I mean, you said they're very wide.
But broadly for Asia Pacific, we are in the world where if we do sustain interruptions to product flowing through the Straits, and you can proxy that through the Brent oil price going to $120 to $130, but obviously some regional benchmarks are well above that, and there's quantity issues as well as price issues. In that world, we would see around 15 to 20% further downside. Broadly, Asia has declined Asian equities around 8% so far. To return back to base cases, were the oil price to fall back to $60 to $70 a barrel and product flows to resume quite quickly, you would maybe have something like 10% upside. So it's actually somewhat adverse from a risk-adjusted perspective.
Okay.
And I think some investors sort of view this as similar to last April when there was a very rapid V-shaped recovery in markets, but that was caused by a significant and rapid de-escalation in trade tensions between the US and China in particular. And that's not what we appear to be looking at currently.
Jonathan, just to, so you're saying that MSCI Asia Pacific ex-Japan, that's the index we're talking about, has got another 15% downside if the disruption persists?
Broad MSCI Asia, including Japan, is down around 8%, and we would have 15 to 20% downside in the adverse scenario where you'd be heading to recessionary outcome across Asia. In the adverse scenario, that's not yet the case. We're trading obviously around $100 on Brent, which is our intermediate scenario currently.
Okay, and this is and what would it take for a recessionary kind of environment? Over 100 for an extended period of time?
No, $120 to $130, and the associated interruption of product flows. It's quantities that matter, not just on oil, but on gas, and then the downstream effect of that on industrial production throughout Asia, production of things like fertilizers, for example, which are very important for India. It's that adverse scenario that would cause a more significant adjustment in equities.
One is, but of course, we're going to ask you market outcomes and what you think of markets and what looks good or bad, but you know, what is Morgan Stanley's sort of team, say, in Washington telling you with regards to the war itself? What's the base case? How long will this go on, and what are the likely, what's the likely shape of this over the coming weeks and months?
I can't comment on that question. I'm not a military analyst or strategist. I'm an equity strategist.
Okay, but okay, fair enough. So there's no base case in that sense. I mean, I spoke with somebody at Fitch who said yesterday on the sovereign side, they said maybe a month is what they think this kind of goes on for. So I thought maybe internally there is a base case on this one.
Our framing of this is in relation for Asian equities and economies to the oil price. So $60 to $70 would be the positive scenario, which will only happen if there's a relatively rapid resumption of flows through the Straits. That's the positive scenario. The intermediate scenario where we are right now is $90 to $100 on Brent, and the adverse scenario is $120 to $130. So we frame it in terms of the Brent price for oil because that's relatively easily recognizable to clients, but there's all sorts of complexities around downstream effects on the economies, particularly in Asia, from the general environment that we're now in. And again, at a high level, Asia is far more negatively impacted across the board than Europe or the US, which is relatively resilient. So in the intermediate scenario and the adverse scenario, the US outperforms in equities. We've been very clear on that with clients.
I mean, I think US produces about 20 million barrels of oil, consumes 20 million barrels of oil a day. Europe, of course, is dependent, and Asia perhaps a lot more, China, India, etc. Just a quick word on India, you said. I mean, India's been sideways for 2 years, is down from the highs and has underperformed generally. Jonathan, is that some buffer if the worst case plays out?
No, it's not. In terms of valuations, India is still trading at a valuation premium to the rest of Asia. And as I mentioned earlier, there are 3 markets that have a large oil and gas import dependencies to GDP: Thailand, Korea, and India. The fact that the market has underperformed is not really relevant for the situation we find ourselves in now.
So currently the base case is that Brent crude is at $90 to $100 per barrel. That's the intermediate scenario. If it were to go to the adverse scenario where Brent crude prices surge to $120, $130, is there a case for a further downgrade on India given its sensitivity?
I couldn't talk about that in a live TV
I thought you were working on various scenarios.
Yeah, obviously, we downgraded India along with other changes that we made to our markets at the first moment of what's now going on in the Gulf, and we'll continually review the situation. What I would emphasize is that it's really important not to anchor too much on base cases and to respect the wide degree of uncertainty that exists on this topic. But there are other topics as well, like AI disruption, for example, that have very profound impacts on Asia. One of the reasons that the Indian market has struggled is the outperformance of upstream semiconductor exposed markets in Asia, like Korea and Taiwan. And for the time being, the semiconductor plants, continue to function broadly as normal.
Jensen Huang said yesterday that the AI demand is exploding and he sees a $1 trillion opportunity. So at least as of now, Jonathan, no signs of peaking of the AI cycle. So Korea, Taiwan will continue to do well and attract capital from the foreign flows, because the hope was that perhaps if the AI cycle peaks out, then money will be redirected. India is sort of a hedge, a counter to the AI upcycle.
Yes, indeed. I mean, we're actually equal weight on Korea and Taiwan as well, because the valuation re-rating of some of the stocks has been dramatic. Obviously, it is not unknown that the semiconductor industry is doing well. But for the time being, whenever our team in New York comes back and looks at this in relation to AI capex, they keep on pushing up the numbers and pushing out the period before which capex might actually start to move back down again, may peak and move back down again. That's now probably a 2028 story, if that. So it's certainly part of the issue that the Indian market has faced, that you have this potential disruption downstream from some of the software services firms that exist in India, whilst the upstream area of semiconductors in Korea, Taiwan, and also Japan is doing very well.
So what do you overweight on right now and underweight on?
We have small overweights on Brazil, Japan, and Singapore.
Okay. Just to take that point on IT services in India, you think what's the thinking, Jonathan? Is there, because the debate is still on how much disrupted, whether there's an opportunity, and how far out will that materialize? In the interim, will there be a fair bit of pain? Just your thoughts?
Well, we've been cautious on this sector for some considerable time in our regional allocations. And again, I know that it's underperformed within the market, as have some of the software and services names globally. Again, I think there's a very wide range of potential outcomes here for this sector. For now, business seems to be sort of busy. There's a lot of AI implementation projects that are underway, but obviously equity markets discount the future, and the sum of those net present values is much more uncertain than it was before.
Jonathan, I'm paraphrasing you, but correct me if I'm wrong. What you're saying is, say if this war ends tomorrow, some of the themes which worked before this war started, I mean, we basically go back to that same kind of environment, those same markets, those same trades, those same themes. Is that correct?
Yeah, so at Morgan Stanley, we have a number of core global themes. So one of them, for example, is multipolar world, which includes geopolitical risk, but also there are sectors that flow from that, like defense spending and capital goods and general industrial spending. Then there's AI and tech disruption and capex, which benefits not just semiconductors, but some of the upstream energy names, particularly in the United States itself, where the capex is significant. We do have Asia reform, things like Korea value up, Japanese corporate governance, to some extent China SOE reform. And then we have sort of longevity, which is a fascinating theme, very playable in parts of the Asian equity market. So these are all core themes, which we've organized our thinking about for several years now.
One theme we've heard from many over the last few years is hard assets, right? And I think, I think this the shortage of oil has kind of put the focus once again on that theme. Hard assets, not just oil, but maybe a lot of other stuff, the metals, etc. But even lesser talked about things. I mean, helium, for example, is gotten discussed because of its uses in so many areas, including chips, semiconductors, etc. Is that one of the big global themes which continue to play out well, Jonathan? Hard assets?
So that's sort of linked. That's linked between sort of multipolar world and AI tech capex sort of / disruption. So again, if you think about copper, for example, that we're structurally bullish on, that's very important in data center build out, but it's also important for industrial processes generally. And then there's other metals that are involved in defense production, where we have very tight supply demand situations right now. Yeah.
Okay. Got that. Just last word, gold and silver, is there a view, Jonathan?
So for the time being, gold is sort of range trading, having had a spectacular year last year. I think it's important to remember that some of the major markets for gold are arguably in somewhat of a situation where the retail investor is not able to participate right now in the Gulf. But also, again, in the case of India, and I'm not close to this on the ground, but if you're in an environment where there's increased macro uncertainty, higher energy prices, potentially higher food prices, then discretionary demand for gold may be somewhat less than we've seen before. And in fact, as a theme across our coverage, we've removed almost all of our consumer discretionary stocks at this point. So we have been making that move more to energy materials and telcos. But gold is certainly a solid hold, let's put it that way, at the moment in the portfolio.
Jonathan, just one last question. In India, and those who are watching you, those perhaps who are focused on India and not around the world who can't, how should they think about this? Now, there is AI, so maybe focus on things which can't be coded away. Again, I come back to hard assets and real physical assets, things like, I don't know, hospitals and infrastructure or
defensive franchises. Yeah, so to be specific, we have 3 India stocks remaining in our emerging markets focus list: Reliance Industries, ICICI Bank, and Bharti Airtel. So those 3 represent what we view as a sort of a core holding in India currently.
ICICI Bank, Reliance Industries, and Bharti Airtel. These are 3 Indian stocks in the MSCI.
Our global emerging market focus list. Yeah.
Okay.
And Maruti, you're recently downgraded. Do you want to take us through that?
I can't comment on that.
Okay.
All right.
All right. I think we'll leave it there, Jonathan. Appreciate you coming on.
Very much. Thanks for having me on. Thank you.
Thank you for joining us. Thank
Bye-bye.
you. All right. Well, that's Morgan Stanley's view and coming in from their top emerging market strategist. We'll take a break. We are back in just a bit. And we have the management of J.K. Simmons joining us to talk about the impact of course, the Iran war and whether there's supply disruption, what's happening with prices. Anuj Khandelwal coming up next.
Welcome back. This is Corporate Radar. Let's welcome Anuj Khandelwal, the business head, J.K. Cement, who joins us on the show. Hi, Anuj. Thanks a lot for joining in. Coming to you in just a bit. For the time being, just highlighting the 3 top discussion points that we're looking at. What's the impact of the Iran war on the input cost? What about cement price hikes? How much is needed to offset this current raw material price inflation? And what about demand on ground? It was supposedly good. Is it as strong? Anuj, thanks a lot for joining in. First, let's focus on the raw material basket. Could you tell us how much of your mix is towards petcoke, how much of it is towards coal, and within coal, how much is imported and how much do you get domestically? Please go ahead.
Okay, Nigel, firstly, many thanks for having me on the segment. Quite interesting times, to say the least. Basically, in our basket, look, it depends across regions. In southern region, around 75% of our fuel requirement comes from petcoke. In the central region, 90% actually comes from Indian coal. So it's quite varied. And in north, it's around 65 to 70% comes from petcoke, while 10-15% comes from Indian coal. So it's a wide variety across the regions, depending on where we have Indian coal supply, where we are dependent on imports.
Okay, all right. And this higher raw material cost will start hurting you from when? What I mean is you normally would be sitting on some inventory, right? So you would get some benefit of lower cost raw material for at least Q4. Would that be fair to estimate? And from when does it start hitting? Second half of the first quarter, or will it be in the second quarter of next fiscal?
Yeah, so basically, yes, Q4 will not have that impact because you rightly said that, everyone does carry inventories, and in the current scenario, they do seem lower cost inventories for sure. Yeah, basically, it will start impacting us from second half of the first quarter, give or take, and it will depend plant by plant and it will depend player by player. But we will see the impact of higher fuel costs coming in sometime from mid-May to mid-June, depending on which player has how much stock of old prices left.
All right. There's a rough estimate that's coming from an MK note that I'm looking at, and various other brokerages as well have written. They are saying at current cost, the way the spike up you've seen in petcoke as well as coal, the cost basket could go up around 200 rupees per ton. Would that be a fair estimate, assuming that they stay at these elevated levels?
Yeah, if you are looking at the current fuel cost as a barometer to judge it, the cost on the fuel side will increase by around 125 to 200 rupee per ton for various players, depending on the region they operate in, depending on the kind of product mix they operate with.
Okay.
So on an average, the industry will have a hit of 150 rupee per ton just on fuel. In addition, we are also seeing a short-term impact on bags cost, which is around 100 rupees per ton or so. So overall, I would say that the cost impact, if we just take today's prices of various materials, it will be around 225 to 250 rupee per ton.
That is fuel as well as bags together.
Yes, and of course,
by bags, I'm assuming it's polypropylene bags, the PP bags, is it?
Yes, absolutely. Polypropylene is the inherent material for the bags, and it comes from refineries. And we have, for obvious reasons, prioritized gas production, right? LNG. So basically, from that perspective, the production of polypropylene does get deprioritized, which causes a bit of a shortage in the markets, which is driving the prices up. So as of now, the bags cost is also 100 rupee per ton up. So that we'll have to see how long the impact is. But if you take the fuel and the bags cost both combined, it'll average hit us by 225 to 250 rupee per ton.
And availability of the PP bags are there? Or availability is also an issue?
Yeah, it's challenging. There's no two ways about it. It's challenging, but I think we are still getting supplies so far, but we have to keep an eye out on how things pan out in future.
All right, Anuj, let's talk about demand. Y'all were bracing for a very good quarter. I understand that in northern as well as central India, demand was strong actually, January as well as February. And there has been some softness in March. So could you help us out with how our demand trends been? And in March, how soft is it in comparison to the previous month? And given that sort of a backdrop, can you push through price increases since raw material costs have moved up?
Okay, let me take the easier question first, which is the demand.
Yeah.
Right. Look, December was bumper, truly bumper. We had not even expected that kind of December. Jan, Feb were also quite robust, and on a pan-India basis and even region-wide, I would say the industry would have grown by 8 to 10%. March, to start with, is soft simply because we had, the timing of Holi between this year and the last year has been different. Having said that, I still believe that in March this year, the industry will end up at a growth rate of 5% or so, which is still, I would say, robust because last March was really good. So as far as I think, the Q4 demand for the industry will end up at around 7 to 8% or so versus Q4 of last year, which I believe is quite strong and good, given how good the last Q4 was.
Okay.
So at present, slight softness seen in demand, but not so much to worry at present. So overall, but in Q4, the demand, I would rate as being quite good.
All right, yeah, on a high base, it's pretty good. 7 to 8% growth is what you're talking about. Just a quick question. Have you all scaled back production a little bit? Or are you all going as much as you all would have liked to, or as much as you all were, say, 20 days or so ago?
So basically, we've not, scale back of production we've not done because it depends on the amount of demand which is there. Demand, I would still say, is robust. We've not had a challenge so far as far as demand goes.
Okay.
But you have to also remember this is March. So basically, this is what we were even expecting, that the demand would be good. So it's broadly okay. We have not scaled back on production. The numbers are quite good. But how things pan out in future is something we are keeping an eye out very actively on.
And since you wanted an easier question, what about pricing? How much higher are pricing on an average in Q4 in comparison to Q3?
So in Q4, look, non-trade prices, because that's the segment where the price volatility is far higher, and it is in a way, depending a lot on demand. I would say on non-trade per se, across regions, we've had a 10 to 15 rupee kind of a jump in Q3 versus Q4. 10 rupee should be the average. And in trade, we've hardly seen any changes. Some regions have seen 5 odd rupee changes. Some regions have remained constant. So overall, trade is 0 to 5 rupees, while non-trade is 10 to 15 rupees.
So back of an envelope calculation suggests that you have pricing benefit, you have operating leverage that will play out, and input cost should be subdued. So EBITDA per ton improves by around 150 to 200 rupees in Q4 in comparison to Q3. Is that a fair estimate?
I don't want to comment on it, because the results will be, we will be very soon entering into a silent period. So I would want to stay away from that question. But overall, various factors which you mentioned are in place.
Okay, Anuj, very quickly, I know you all have operations in UAE, you're in charge, and you have, better insight on the India operations. But given the kind of uncertainty in the Middle East, are operations functioning as normal, or has there been some kind of scale back out there? What have you heard from your counterparts there?
No, see, there are challenges as you all have heard, but we are looking at the situation very clearly and very, very carefully, and things are too fluid for me to comment on it.
All right, we'll leave it there. Thank you very much. Good luck, and we will look to speak with you soon again. Thank you. From the last time that we looked at the markets, it's a complete U-turn which we've seen. We are at, we are above yesterday's high. Yesterday's high was about 23,500, 505 or so, and we've crossed that level. Look at that. And bulk of that move has materialized in a fairly short time span. If you look at it, I think the one-way move started at about 950 or so, and we're at about what? So in the last 10 minutes, we've moved about 100 points. Not 100, maybe a little less than that, but about 60, 70 odd points or so. The low, of course, was made at about 928, which was about 23,346. 23,590 is the upper end of the channel. So let's see. That is the level we put out in the morning. Let's see if you're able to cross it. If you're able to cross it, then you perhaps are looking at 24,000 kind of levels. If you fail, then you basically are coming down once again. So not very far. We'll find out if there is enough here for the market to test those levels. That is about 23,590. Just a quick word on the IT index, which is exceptionally weak today.
Well, it's recovered. It was down 2.5%. Now it's down 1.5%. So from the lows, it's up about 1%, but still down 1.5%. Actually, the recovery is coming in the auto names. The Nifty Auto Index is right on top. It's a near 2% gain on the Nifty Auto Index, with M&M, Maruti, Eicher Motors, Bajaj Auto all gaining between 2 to 3%. Eternal has moved up smartly. That's up about 3.5%. And metals.
Incremental recovery in the market is IT.
IT. That's a 1% recovery from lows.
Auto index was strong. It has become stronger. But the IT, and let's just put the intraday up, that is where that turn has come from the day's lowest point. So about a 1% pop from the lows for the Nifty IT Services Index. Chandan Taparia is with us at Motilal Oswal Financial Services. Chandan, good morning. Good to have you here. Just a quick word on the price action as you're seeing, and where would, what are the pivots you're watching closely, and what would confirm upside or, a reversal once again here?
Yeah, good morning, Prashant and Nigel. Thanks for having me. So yesterday, Nifty formed the bottom near 23,000, witnessed some recovery led by some short covering and improvement in the put-call ratio. Today, after the opening, it's holding the key support of 23,333. So for me, the hold of 23,333 is very important, because what we noticed in last couple of days when market was declining, it never witnessed the follow-up for second days. So if 23,333 is being respected for the day, then I believe this recovery can extend some more bounce towards 23,750 to 24,000. So on intraday point of view, 23,333. For positional point of view, 23,000 could be the key support and looking for some more bounce in the market. But we need to keep in mind that about 24,200 to 24,440, the major trend will change. But till then, we are looking for some recovery or bounce setup in the market. Now, talking about Bank Nifty, here we witness a bullish engulfing pattern on the daily chart. Major support on immediate basis at 54,000, looking for a recovery towards 55,000 to 55,555.
Okay. Any stocks, Chandan, that you'd like to bring to our notice?
Yeah, Rima, so positive on the capital market infra theme. Sensex is our first trade. We are quite positive on the same. The good part is that even after the market corrective move, the counter is holding well above 50-day exponential moving average. Major trend of the counter is positive. Longs are intact with put writing activity. Rollovers were also positive. So most of the data set, whether we talk about the technical derivatives or the quantitative, we are getting the positive stance. So recommending to buy with support of 25.50 for an upside target towards 27.20. Again, second idea, buy on BSE, resilience, positive on the capital market infra theme, recommending to buy with support of 28.60. And this time this counter can head towards 3,050 kind of level. And third trading idea, that is on metal. Nifty metal index is now bottoming out. And Tata Steel is now taking support at the previous hurdle. So role reversal pattern is visible on the daily chart. And after the correction of last 2 weeks, we are witnessing some put writing and support based buying at the counter. So one can buy with support of 186 for an upside target towards 203 levels.
Thank you very much for that. Scient DLM is a big mover today, 14% up. This is after JP Morgan upgraded the stock to an overweight, raised the target price to 400. So that stock is surging. Current market price 340. So they still see a lot more upside. The other upgrade they did was an amber, but here the gains are more muted, up to 3%. We will slip into a break on that note. On the other side, Manisha Gupta will come back and focus on commodities. Stay tuned. Welcome back. It's time for our commodity check. Manisha joins in as always, and she's watching the rise in aluminium prices today.
Well, that's just a couple of commodities that actually have continued to rise consistently. One is energy and the other is aluminum. So when you look at the prices therein, we are trading at a 4-year highs onto this one. On a monthly basis, we have gained by 12%. And for this year, it's outperforming various other commodities as well. So in the last 12 months, we've seen 26% of gains come in for the aluminum prices. Interestingly, when you look at the cash trades, they are trading at a premium rather than the 3-month contracts. Well, actually, I was looking at the December 2027. That's trading at a $3,000 a ton. The current price is at around $3,500 a ton. So we're looking at these very strong premiums that the producers seems to be charging, or smelting countries seem to be charging right now in Japan, in US and Europe as well. Japan actually seems to be charging nearly $300 a ton of a premium to its Asian consumers right now. All of this really comes in after the Persian Gulf, which accounts for nearly 9% of global aluminum output, is looking or is tied in with this conflict therein. There also are reports of closure of Strait of Hormuz interrupting a lot of shipments when it comes to aluminum as well. And there are certain reports which suggest that nearly 564,000 tons per annum of a capacity, which is 0.8% of global capacity, is in process of shutting down in West Asia there. Two major smelters within the area, whether it's about Qatar or Bahrain, already have taken a hit and have been forced to suspend deliveries. There are a couple of smelters which also have done a force majeure out of there. If you look at Rio Tinto, that has been offering aluminum to Japanese buyers at a premium of $350 a ton therein. But the latest news, of course, comes in from Bahrain, where Bahrain's Alba, which is the world's largest single-site producer, has shut 3 production lines there, which together accounts for nearly 19% of its capacity, which, by the way, is at around 1.6 million tons. So those are the kind of shutdowns, the huge ones that we are looking at in the international markets. Apart from Middle East as well, it is about China, which is the world's largest aluminum producer. Well, there are concerns of production into this one as well. The government has put a curb of 45 million tons, which China hit in the previous year itself. So China perhaps is not looking at any more production growth going forward. We actually could be looking at a decline to curb overcapacity is what seems to have been bothering the markets in any case. Aluminium inventories, when you look at that, those have continued to decline in London and in Shanghai as well. An interesting report from ING says that the supply shortfall for 2026 is estimated at around 600,000 tons right now. So apart from Middle East as well, aluminum had been doing quite well. This just adds further premium in case of prices there. Take a look at Indonesia, which is also a high in case of smelting, but they also are struggling to build new plants due to high energy costs and, of course, local regulations as well. The production challenges in Mozambique also have been supporting the aluminum prices. When you look at the various reports on where the aluminum prices could go from here, well, that's a lot of bullishness continuing. We are trading at around $3,500 a ton right now. Citi says that $3,600 is their near came base scenario, but $4,000 is what they're talking about in a very bull case scenario as well. It's a similar report that has come in from Goldman Sachs as well. $3,600 is what they are dealing with if the production in West Asia is lost for more than a month. A latest report from Morgan Stanley also has come, and they also say that their base case scenario when it comes to aluminum stands at $3,700. Not too far away. It's $200 away from where we are trading right now. So aluminum continues to be an outperformer on a week-on-week, month-on-month and year-on-year basis.
Right, Manisha, thank you very much for that. Well, it's commodities in focus. More later. We are going to take a break. We are back on the other side in a special Indianomics program. Lata discusses why the IDBI divestment is flopping with former RBI Deputy Governor S.S. Mundra, former Bain Senior Partner Harshvardhan, and founder of New Strat Advisors Abhizar Devanji. Conversation follows in just a bit.
Welcome to Genomics. The IDBI Bank divestment was actually flagged off in the February 2016 budget speech of Finance Minister Arun Jaitley. Yes, 2016. And the latest we hear 10 years later is that even the couple of bids we got this month are likely to be rejected as they are below the government's reserve price. Why is the government unable to divest from IDBI Bank even after 10 years of debate and processes, while RBL Bank could sell a fresh 60% stake to Emirates NBD Bank for a whopping 26,850 crore? And Yes Bank's 8 shareholders could sell a 20% stake to SMBC for 15,880 crore. Foreign buyers appear to be ready to pay, but government is not able to cash in. Why? That's the question we're asking today. And joining me are Mr. S.S. Mundra, former Deputy Governor of Reserve Bank of India and former Chairman of Bank of Baroda, Chairman of BSE as well. Also joining me, Harshvardhan, the banking expert and former senior partner at Bain & Company, and Abhizar Devanji, also banking expert, founder of Neostrat Advisors. Gentlemen, good morning, and thank you very much for your time. Mr. Harshvardhan, if I may start with you, what accounts for this failure of the government to click in when private guys are doing so well and getting buyers easily?
Yeah, so Lata, I was saying that, look, you have to keep the broader context in mind. This is the first time the government is trying to sell a very large financial sector entity. This has never happened before. So there is no experience in the government to go by. IDBI is over 80,000 crore market cap company. So if we are to sell even 50%, this is a 40,000 crore plus transaction. This is a very large transaction. And so obviously both sides, the buyer and the seller, would be extremely careful in a transaction like this. Even in private sector, when such large transactions happen, your investment banking friends will tell you a lot of energy and mind space gets spent in something called representations and warranties and indemnities, when the buyer essentially protects the seller from any unforeseen eventualities that might arise post the sale that happens. So my sense there is, and this is entirely based on public domain information, I have no private information, is that one, given that there has been a dramatic turnaround in the performance of public sector banks, the government's valuation expectation may have gone up. That's where your comment about reserve price not being met would have come in. And secondly, any buyer, private sector buyer, investor who's going to deploy so much capital would expect an unconstrained transfer of management control. And that in a government entity could always pose a challenge. There could have been employment contracts, there could be other sorts of constraints on the way the bank will be managed post-acquisition. So my guess is those are the two main areas which could hold the government from pursuing the transaction, just based on public information.
Okay, Mr. Mundra, you have seen all formats, private and public sector, as well as you have made policy. What is your sense? I personally thought the government got everything right. First of all, it is under the Companies Act. IDBI, unlike the other PSU banks, is not under the Banking Companies Act, which is a more difficult act, where government appoints CEO. In IDBI Bank, because it's Companies Act, the NRC, the board appoints the CEO. So it looked clean as well. Axis Bank was under LIC and it was very easy to treat it as a private sector bank. So that is why they did this LIC routing. They seem to have done everything right. Why do you think it's flopping so badly and taking so much time?
Okay. Interesting, Lata. First, you mentioned about the private banks are in a position to easily and why we are facing so much of difficulty here. Let's understand one thing. In most of those cases, the investors have chosen to pick up a strategic stake, not necessarily the majority control. And basically, you have to look at the transaction from 4 or 5, I would say, broad criteria. One is the transaction structure. Other is the regulatory framework which is likely to come. What is the valuation expectation? What is about the governance and any legacy concerns are there? And finally, the bureaucratic framework. If we look at it, I would initially touch upon two things. Number one, transaction structure. I think in case of IDBI Bank is a very complex transaction structure in the sense that government is holding something like 45.5%, LIC is holding 49.2%. Put together, they want to divest 60.7%. And both the owners would have their own expectation. Government would have the policy issues and the fiscal targets. LIC has to think about the return to the policyholders' interest and return on investment, more so now when it is listed. So I think in this complexity, an investor would probably have a very clear transaction, clean transaction, where the transaction structure complexity are minimum. It is driven by the market valuation, and the regulatory framework is much easier. I think these are the points. And as Mr. Harshvardhan also mentioned, what we understand from that, probably the mismatch has come in valuation expectation. So I think the requirement would be seeing the divestment by both the owners and be prepared to accept the market valuation. Because the market valuation would depend on the asset quality, the future growth possibilities, how much the integration would be complex. So these are the kind of things which, would determine. I know both the things are difficult, but I think they are imperative. They would need to be done.
Okay. Actually, we are playing out, as you spoke, the ROA of the three banks, RBL, Yes Bank and IDBI Bank. And IDBI has a higher ROA. But, both those banks went for like 1.1 times price to book and Yes Bank at 1.4x. In IDBI's case, if you take a book value of, I think, about 60 rupees they had, or 55 to 60 rupees, as of December, Abizar, it was trading at 100 rupees. I mean, the market price was asking for something like 1.8x. Do you think that it was the market price which spoiled the whole thing? What according to you is going wrong over here?
I personally think, assuming it is spoiled, because we don't really have the government answer to it as yet, assuming it is spoiled, I really think that the larger issue is only about price. Because while, we had Mr. Mundra as well as Harsh talk about the fact that, the deal is complex, etc., the complexity was known. I think every bidder knew what they are getting into. They're getting into a more or less pari passu stake with the government plus LIC. They're getting in, also not stake, voting power, as the two of them. The multiple was what it was. I think the real issue is around the price and the way the price has kind of gone up. And frankly, this deal at 70-ish, I think, was a very doable deal, because it would have been comparable with the valuations of, say, a Yes Bank or a Yes Bank at 1.2 and RBL at around 1.06 times book. So that is really where the valuations would have been at. And I think it's only a valuation issue as of now. Not really a deal structure and complexity issue, because those complexities are known.
Okay. Mr. Mundra, to come back to you on this point, when I was preparing for this and I spoke to a lot of former government officials, one of the points that came from everyone is that bureaucracy or IAS officers worry about the CVC. If they sell it for probably, 1.1 time, and later on the price is trading at 1.7 time or 2 times book, then somewhere down the line, a CVC questions, did you sell the family silver very cheap? Is that a very important problem? For Subramania Kumar at RBL or, for the group of banks that sold Yes Bank, they just want to get on with business. They won't have so much of a CVC issue. Is that the big difference between private and public?
See, there are concerns. There have been historical cases, but I don't think that can only be the overpowering thought if a case is well made out. And now there is a whole history. I mean to say, even the current round is now 4 years old, and the stock is going on for 12 years. So there is enough history available that what are the impediments and how to move forward. But as I mentioned earlier, it's a difficult decision on both the sides. Those concerns will be there. But let's understand one thing. And sorry to say that, but if you look from various criteria, IDBI Bank is neither here nor there. Is smaller than many private banks. it has not a great retail franchise. There would continue to be concern, true or wrong, I don't know, but about the legacy book. So if that is the profile of the bank, then obviously, as I mentioned, that any investor would look at the future growth possibilities, that there are no asset quality risks, what kind of capital they would be required to commit, and how difficult would be integration, both from the viewpoint of manpower as well as technology. So all these things are factored into pricing. And so if all these factors are taken into account, a case is well made out. I think it will require a determination and a political will probably to sell it through. It's high time. This has been a work in progress for very, very long. And I think it's time to move on.
Oh, absolutely. Abhisar, what is your sense? Were they wrong, in fact, to have gone with government, LIC? Because there were some people who said that the guy who came with that, who would buy that 60% stake would still have only 26% voting rights. And the balance, if you make LIC and government look like the same entity, then you are still not having control. So the whole idea was wrong because the person who bids won't feel like he's under control. Is that the problem?
Absolutely right. That is one of the issues, but that would have been baked into the price. Okay. So that's why whenever somebody said that, oh, because you're acquiring a 60.5% stake, you should be paying a control premium. There is no control. Because if you work the mathematics of the voting rights, 46% voting right will remain with the new incumbent. 45% combined voting right would remain between the government and LIC in terms of 100%, and the balance 9.5% would remain with the shareholders. So actually demanding a premium was clearly not a proposition here. About whether it is the government control, whether it is the fact that you need to toil to turn around IDBI, was all factored into the price. Now if you look at other comparable transactions, they happen at around one-time book.
Yes.
Now there is a reason for that. And frankly, a justifiable reason even for IDBI, because IDBI over the years has not only cleaned up, but collected a lot of their NPLs. So a lot of profitability and return ROE comes in because of NPL write-backs.
Yes.
Plus, there is a very stable mortgage business that they have built. So from a business point of view, at one-time book, it was a perfect buy, given the franchise as Mr. Mundra also spoke about.
It has improved.
There is a franchise that is there, which demands a 1.5 times. Somebody would have had to come and rebuild on that franchise. Clearly, there was value. The other thing one has to say, as you rightly said, that Mr. Arun Jaitley flagged it off in 2016 and we are where we are today. There is this concept on investment banking called deal fatigue. And what really happens is that when a deal carries on a protracted manner, with multiple news coming in saying, oh, the bids are being invited today and tomorrow and day after, the cry wolf kind of comes into the system.
Fair enough.
And and lastly, above everything else,